You asked and we listened. We're going to answer 11 and a half questions from our audience. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell, and joining me as always, Christina Wyatt. How you doing, Christina?
Hey, Darren. I'm doing great. Excited to answer these 11 and a half questions from our audience.
I'm excited too. Spent a lot of time in that half question, though, so we'll dig into them.
Before we get started, let me just remind everybody, if you're listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review. And if you're listening or watching on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. And don't forget to follow us on our social media accounts at Control and Compound on Instagram and TikTok.
Very cool. Okay, so let's dig into it, Christina. I like this. We had some fun with this one. So again, this is listener audience feedback. So thank you for making comments, asking us questions. We're happy to do this, and we'll keep doing it as long as you keep asking questions. So Christina, why don't you handle the first one? What do people want to know?
All right, let's jump into question number 1. Is the death benefit taxable in Canada? So this is a great question, and the answer is no. Better answer. Death benefit is not taxable in Canada. Now, if you do name your estate as the beneficiary, it can be subject to probate because it's going to the estate, but we fix that problem by naming a beneficiary. So we always recommend whenever possible to name a beneficiary, then it's going to bypass probate, going to be completely 100% tax-free.
Very cool. All right, next question. What is the MEC line versus the MTAR line? Great question. We get a lot of that because people watch in the state or watch videos from the States or read books from the States, and they see this MEC line. So a MEC line stands for Modified Endowment Contract in the States. Canada, we have the same thing, except we call it an MTAR line, which is the Maximum Tax Actuarial Reserve line. So if you know that one, you're in the minority. But we think of it as a maximum line that you can put premium up to the maximum line. Now, why do they have maximum lines? Well, the government limits how much you can put into this because this stuff is good, right? You'd want to buy $1 of death benefit and put in $1 million. Well, you can't do that, but the limits are very generous. So when we design a policy, we want to be right up to that MTAR line or maximum efficiency line, and that's going to give you the highest cash value and for that particular death benefit. So we want to drive the death benefit down, drive the cash value up. The way we do that is we go right to that MTAR line or the maximum efficiency line.
Perfect. Great question. All right. Next question that we have here. What is CSV? So that is an acronym. Acronym for cash surrender value. So cash surrender value is the cash component of your life insurance policy. So when we talk about borrowing against our cash value, this is it, the CSV. So we can borrow up to 90% of that cash. And if you cancel the policy, you would receive the cash surrender value back from the policy. So CSV equals cash surrender value, the cash component of your policy.
How do you borrow against life insurance? Well, in Canada, we have 2 types of loans. We have policy loans, and then we have collateral, third-party, or bank loans, okay? Policy loans or bank loans. Most people are going to be taking policy loans. Those are contractual for the companies we deal with. 90% of your cash value, contractually, they will loan you money on. Sometimes we use a bank loan or a third-party collateral loan in retirement or in some particular circumstances. That's not contractual. The policy loans are contractual. But people ask, well, what are they going to change the rules that I can't borrow when I retire? And I say to people, this is just borrowing against an asset. So, we can borrow against a car to buy it. We can borrow against a house to get a mortgage. So if you think mortgages are going to be around in 25 years, that's just a loan against an asset that could drop in value. This is just a loan against an asset that cannot drop in value, is guaranteed to go up, and comes with a death benefit. So you're going to be able to borrow against your life insurance forever.
These are some great questions. All right, what is my next one here? So this is a good one. How do you find a qualified infinite banking concept advisor? So an IBC advisor, where are you going to find one? So really good question. You want to be working with someone that specializes in infinite banking. There's very few across Canada that specialize in this, and not every advisor does it all. So I see a lot of financial advisors out there that, they're doing your life insurance, they're doing your group health benefits, they're doing your mutual funds, your stocks, all these different things. Well, it's very hard to specialize in something if you do it all, right? So you want to find someone that 100% specializes in infinite banking. And how you can find that is, there's qualifications out there as well as the resources that they offer. So we talk about it a lot that, to use and utilize infinite banking, you have to learn about it. You have to educate yourself. So the person that you're working with should provide resources, should provide the education. They should be providing you with all of the information that you need in order to, succeed with infinite banking. And those come in forms of books. We have, Be the Bank, podcasts, you go onto the websites, you've got blogs, you've got webinars, all of those different things. If you see that the advisor is providing all of these different resources, if they're specializing in this topic, then you're going to find someone that can do it right. And again, very few qualified across Canada. So make sure you do your research and find that person that's going to work well for you. Oh, and last piece, they better be doing it too, right? Like you don't want to work with anybody that's not actually practicing what they preach. We say that in every aspect. You want to make sure that they are also doing infinite banking.
Yep, I love that, and I think one of the reasons a lot of our clients like dealing with this because we are business owners, we are real estate investors, we are someone who wants to take advantage of opportunities maybe outside traditional financial planning, and the wealthy people tend to do that. The real estate investors tend to do that, and the business owners tend to do that. So it's a nice fit.
Exactly. All right, I have the next question here. What is a contingent beneficiary? So I call a contingent beneficiary a backup beneficiary. It is if your beneficiary, your primary beneficiary, was unable to take it, so they're probably passed on. So if your main beneficiary has died, your backup beneficiary or your contingent beneficiary comes into place. So a lot of people will name a beneficiary and and that beneficiary might be their spouse, and then they have their contingent beneficiary. So if something happened to them and their spouse at the same time, it's automatically going to default to that contingent. If you don't have a contingent beneficiary, it's going to default to your estate, and then you could be subject to probate, like we talked about earlier. So if you can, name a contingent. If you don't name a contingent, it's going to default to the estate.
Okay. Next question. Is a corporate-owned life insurance policy taxable in Canada? And the answer to that is no. So if you have a corporation and you buy a policy inside the corporation, if we just stick to, say, term insurance, and it's $1 million, that $1 million is received tax-free to the corporation. If you have a cash value life insurance policy inside a corporation, the growth is tax-free, the loans are tax-free, and the death benefit is tax-free. Now, having said that, there are some situations where if you want to move a policy from one corp to another or personally to corporately, then there could be taxable consequences. And that goes back to the previous question about dealing with an expert at that. We've seen all kinds of cases in our office where someone comes in with an existing policy, corporately owned, that is just set up incorrectly. And there can be tax implications to fix that. And there could be real long-term ramifications. So make sure, especially on a corporate policy, we tend to be talking bigger numbers. Make sure you're dealing with someone who's an expert at this.
Absolutely. Great point.
Okay, we got another question here. Should I buy my house with my life insurance policy? I don't like this strategy at all. No different than if you had $500,000 cash and you're a real estate investor or business owner. Should you put the full $500,000 and buy the house with cash? I don't like that approach, just like I don't like using all the proceeds or all the cash value from your life insurance policy to buy your house. I'm a big fan of using the 20% or whatever your down payment is to make a down payment from a policy loan. Great, that's fine. But I look at it, why wouldn't I get the cheap bank mortgage rate and then keep my capital there? So if an opportunity comes along, so maybe I can buy 4 or 5 houses instead of one. So to use all your loan from your policy to go into a house, I think you give up control now. Now you don't have control of the money. And the next time you see an amazing opportunity, there's a piece of real estate down the street that goes on a fire sale, and you're like, what a great chance, what a deal of a lifetime. Well, you don't have resources to take advantage of that deal of a lifetime. So I don't like that strategy at all of using your cash value life insurance or a policy loan to purchase the full price of a house. Don't like it.
All right, next question. So what happens if I cancel my policy? Good question. never cancel your policy. But we'll answer the question. If you cancel your policy, you will receive your cash surrender value back. So the cash component of your policy you are going to receive back. Now, a portion of that can be taxable if it's above the adjusted cost basis or ACB. So you want to be aware of that. Again, going back to why you would want to work with someone that specializes in this. But yeah, if you cancel your policy, you're getting your cash surrender value back. Oh, I got one more here. So what happens to my policy if I get divorced? This is a common question with couples. What would happen if we became divorced? Well, policy is going to get looked at just like any other matrimonial property. No worse or no better having it. It's just like having cash in your bank account, but they're going to look at that as an asset that's going to go into, your overall assets and get split up accordingly.
Well, as I said for years, I have a lot of rich clients and I have a lot of divorce clients. I just don't have many rich divorce clients. So again, cash value life insurance, treat it as a matrimonial asset, no different than cash in a joint bank account. Okay, so for Christina, for this half question, so for the 11 and a half questions, for this half question, do I need to update my will when I get a policy, and can I change the beneficiary? So do I need to update my will? Not if you have a named beneficiary. So if you have a named beneficiary, your spouse, your children, business partner, that money's gonna bypass the will, bypass probate, go directly to that beneficiary. If you have your estate as the beneficiary, sure, you want to make sure who inherits your estate. But if your estate is as simple as in your will, it says everything goes to my spouse, and if I'm deceased, everything goes to the kids. Well, your wishes are going to be followed if that life insurance is payable to the estate. Corporate owned policies. Key thing here is if the corporation typically is the beneficiary, then who's really going to get those proceeds, or whoever owns the shares of the corporation after your death. So you got to be really careful on a corporate owned policy to make sure it's set up properly, because if your spouse is not going to inherit your shares and your business partner is going to inherit your shares when you pass away, well, then your business partner is going to get those insurance proceeds. So you want to make sure that's set up properly again before you do it. And can I change my beneficiary? You can absolutely change your beneficiary if it's revocable. Every policy we've ever set up has a revocable beneficiary, with the exception of one or two. So a revocable beneficiary means you can revoke that beneficiary and put a new beneficiary at any time. There's one province, Quebec, sometimes a revocable beneficiary is required. So forgetting about Quebec for a sec, sometimes there's a court judgment where in the case of a divorce, a judge could say, okay, the wife needs to have $1 million of life insurance payable to the husband for the next 10 years while he's raising the kids or something. And then that would be an irrevocable beneficiary, which means it cannot be changed or revoked unless the beneficiary signs off on it. And that's just typically to protect the beneficiary, or protect the beneficiary where the owner of the policy changes the beneficiary. So that's a rare circumstances. 99.99% of the cases, absolutely you can change your beneficiary at any time.
Awesome. These are some great questions. I like getting questions from the audience because it lets us know what you're thinking and how we can, put together and answer more topics and things that are relevant to you guys. So
that's awesome. So thanks for those questions. Keep them coming. We're happy to answer any more questions you guys send along. Thanks for watching. Thanks for listening.